All right, so let's get into some things. Obviously, y'all know we're going to be talking about some options trading. This Thursday, make sure y'all tap in. We're going to go over a lot inside of the world of options because there is a lot to go over. And we want to make sure that everybody's prepared if they're going to be in the space. We want to give you the most information as possible so that you can make an educated decision. So make sure y'all tap in. Shout out to everybody that's been part of the first two master classes. Appreciate y'all. Appreciate all the feedback. But we're going a little bit deeper into the dive this Thursday. So make sure y'all tap in. All right. So here we go. All right. So we're going to talk about a company that we've been speaking about since October. Like I said, we talked about this in Chicago. But the reason I wanted to come back to it is because a few weeks ago on Market Mondays, we spoke about how we had a short-term loss. Now, I didn't really take it as a loss only because I had made profits on some other investments I made with HubSpot. I used some of those proceeds to invest in a short-term option play. It didn't work out. Shadi reminds me about it probably every other week. So I said, you know what? Rather than finding a new position, let's show how we can learn, how we can execute, and how we can actually make profit off of the same stock, but just having more information, more resources, and a better plan. And so today we're going to talk about the plan that I used and show you how that plan worked out. And so for those who are not familiar, HubSpot is a customer platform that offers enterprise software for marketing, sales, customer service, content management, operations, and e-commerce. And so what it is a CRM, right? So it focuses on small, medium, and large businesses. And why that is important is because look at its competitors. We know Salesforce. That's huge. We're talking about corporate accounts. But sometimes in business, and we've said this a multitude of times, is that sometimes when you're smaller, you're able to maneuver a little bit with more freedom, right? This is still a big company. I think 35 billion is the cap. And so it's not a mega cap, but it has made some substantial gains over the past 10 years. And so the fact that it's not trying to go after every customer, it's going after specific customers, mainly entrepreneurs and people who have small and medium businesses. This is actually working for them. This has had them reporting great quarters for the past 2 years. I'm going to go to that in a little bit. All right, so here's his competitors. Like I said, Salesforce, Mailchimp, Pipedrive, and Zoho. Some of these companies you may have heard of, some of you may not have. That's okay. I just wanted to give you the picture of who they're up against. All right, so this is my strategy, and I should have been disciplined with it the first couple of times I did short term. Like I said, usually I don't. I like to go leaps, maybe a year and a half to 2 years out, just because it gives me a lot of time as a valuable asset. But I said, you know what? A lot of people are looking, how can I make income today? How can I make $100, $200? I said, let me come up with a strategy that would be beneficial for people who are trying to do short-term trading. And so here's how I'm evaluating if I'm doing short-term. First thing I want to know is what direction is the chart signaling, all right? So I'm going to look at a chart. I'm going to see if it has positive momentum moving up or if it has negative momentum moving down. Like this could be a great indicator because it's going to show me a few things, whether I'm at a peak and it's not time to buy, or it might have hit a point of depreciation that says, okay, now's my time to get in. Second thing I got to do is look at the economic factors that are in play. So what does that mean? That means, and this is what I didn't do last time because I wasn't being as disciplined as I should have. Quadruple witching was happening during the time I did those short-term options. And I said, oh my gosh, there's going to be a sell-off. Why did I do that? But I was already in the call. So this time I said, look, I want to make sure that is witching happening? No. Is PPI coming out? Is CPI coming out? No. Well, what is coming out? Well, last week we had the jobs report. I'm going to tell you why that is important. All right. We're going to see how that played a role into me making a decision into investing into this call. And so I want to look at the economic factors. Okay. Check. Last thing is the 40% depreciation. Like this sounds crazy, but if we were listening to Mr. Rogers last week, he said it to us. He said, when he's looking at equity, like when he's looking at equity, I'm looking at option, right? He said that he wants to see a 40% decline. And I'm like, yes, that's the number. That's the number I want to see. And so I'm always looking for calls that have depreciating value because that means that there's room for growth on the upside. And so I like to see the number around 40. If I get something more than 40, now I'm really interested. I'm going to show you what that looks like right now. All right, so let's go over the first piece of evaluation, and that's the chart. All right, so here's HubSpot's chart, right? And if we're looking at it, It has its moving averages here. We got the 50, we got the 100, we got the 200. But I'm going to focus on the 50-day. All right. I'm going to focus on the 50-day. So I'm going to go start back here. How many times does it come near or touch that 50-day? And for those of you who have a big screen TV or you're in your computer, the 50-day is this purple line that's moving throughout this Bollinger Band. So that's the 50-day. And so in late November, it comes near it and it moves higher. Okay. I'm watching this pattern, right? Then in late February, right, we come all the way down here, right? It hits it again. And then it moves higher. And then it moves in March, again, touches it, and it moves higher. In April, we saw a huge spike. Now, the huge spike happens to be the time that there was a potential partnership between HubSpot and Google. Google was interested, or allegedly interested, in purchasing HubSpot. And so that had the equity move up in stock price. And so it jumped all the way up to 693 intraday, and it kind of settled around 386. But then it pulled back. And so we pulled back again, right back down into its 50. Now, something very important happens, right? So when it falls back in late April and moves slightly higher, but then the start of this month, May 1st, we watched it go below the 50-day. And why is that important to me, right? Because if I'm watching this cycle on the 50-day, 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 touch it, go up, touch it, go up, touch it, move higher, touch slightly higher, right? Now it touches it, and now we're talking about support. So it dropped below that 50-day moving average support line. And so now I'm looking at a stock that is falling. This tells me, if this is a company that I believe in, it's a company I've been watching, this might be a point that I can now enter the position, okay? Because we don't want to buy high, right? We want to buy low and sell high. All right, so let's go to the next piece. All right, so that's the first piece. The chart is telling me where the company is moving. I'm looking at those signals. The next thing is the economic factor. So what should we expect on the jobs report? So on Thursday, I'm looking at myself, all right, okay, well, what are they saying? What are the estimates saying? Why is this important? Well, here's why it's important. So an economic slowdown that could help ease inflation and trigger interest rate cuts. That's the news that we're looking for. And what does that mean? Because most people are like, I don't even know what they're saying. Well, here's what it means. If less people are employed, and this is the unfortunate circumstance when we're talking about the economy, if less people are unemployed, there'll be less capital to spend. If there's less capital spent, that will encourage the Fed to lower interest rates. Lower interest rates are great for all businesses, but even more so for tech companies, because it makes it easier for those companies to get funding, spur investment in innovation projects, and broaden the market. And so when we're looking at the unemployment numbers, if they come in high, that won't be a great sign. Why? Because it tells the Fed that people are still spending at an alarming rate, so we have to keep the rates the way they are. If less people are getting jobs, there's less capital, less spending. Okay, maybe we should cut rates. So this is Thursday of last week. The expectations for the job number is to be between 230 to 275,000 jobs created. So there goes my second piece of information, right? I looked at what the chart was doing. Then I'm looking at the economic factors. So once I looked at the economic factors, I'm saying, okay, well, let's go to a place where we can now see the options, right? So if I saw it pull down to 592 at the time, and this is where it was Thursday, I said, well, let me see an option in that range, right? So if it was trading at 592, let's go from 580, let's go all the way up to 660. And so I click my strikes. I want to see 11 of them, and I want to see them around 630 is a decent number, right? Because we've seen it at that point in early April, mid-April as well. And here's the alarming thing, right? The first thing that I notice is, wait, there's an open interest, right? And where am I looking at that number? Right here, right? It says 2,118 open interest at 650. Well, that tells me something. That tells me that people are looking at this 650 number. Now, if you were in the stock class at the first session, we talked about using AI as a component to help you figure out where your strike price should be. And from what all analysts said, they said the strike price by the end of the year should be 680. And so the 650 shouldn't feel unfamiliar to you, or even feel alarming to you, right? And so we're looking at that. All right, I'm looking at the bid for it. Right now, this is obviously a later date, but when I was looking at Thursday, it was a little bit low, and I'll show you what it was. But this open interest is like, okay, I like this. 2,000 people. There's 2,000 open interest in there. Let's dig deeper. So I dig into the details. Let's hit the detail button. See what comes up. All right. So when you hit the detail button, here's what you're going to look at. It's going to tell you the exact call at the exact price and the expiration date. So the expiration date is May 17th, which is not very long, right? That's next week, right? So here's what the underlying price and volatility of this equity, right? So we're watching the equity. It started here, and we can see over the past couple of days, past couple of weeks, where it now sank up until this mark right here, May 2nd. This is when it's trading at 592. And I'm like, oh, perfect. This might hit a number that I like. Now, this is for the equity, right? That's if you're buying the stock, but we're not buying the stock, right? We're buying the contract. And so the next slide is going to show us what the option price is. Now here's the golden goose right here. And so if I'm looking at this slide correctly, I'm looking at the option price, and I see on April 11th, this option, this call at 650 was trading at $49.99, right? So that's about $5,000 a contract. Well, it goes back into my rule. My rule is 40%. So if I'm at 40%, this is easy math. Let's round that up to 50. Half of that would be 25. That means that if it's at 25, that's half. A little bit more of that, so it's $28. And it got down there, right? Got down there at the beginning of the month. So May 1st, it was sitting at that 25. And I said, let's just be patient because it could go even lower, right? This jobs thing could really affect it. It's a tech company. It might pull back even lower. So we wait a day. And then what happens the next day? It drops down to 13. So now we're not talking 40% anymore. Now we're talking 70% depreciation. Now I'm even more interested. So I'm like, okay, there's something here, right? Now this is very intentional, right? Because like I said, we like to do leaps, but I want to show people with this type of strategy, if you're super intentional and you're patient, it could also work. So I told you at 40% decline, I'm interested. That option price fell from $49.99 on April 11th to 13 just 3 weeks later, right? So last Thursday fell to a market decline 70%. Now I really like this position. So the next thing I do is, all right, well, let me get some more data on what to expect. So I go to estimize.com. Estimize.com. Why do I go there? Because I want to see when they're going to report it, when the company is going to be reporting, and what the revenue is going to look like, the earnings per share is going to look like for the quarter. And so I use Estimize all the time, right? And it tells me the next time they're going to report is in 2 days. So that means that they're going to be reporting on Wednesday. Great. Let's see how they performed over the past 8 quarters. Well, let's see what Wall Street expected from them, and let's see what actually happened. All right. So we saw revenue growth. We saw revenue growth. We saw revenue growth. We saw revenue growth. You see the pattern? Revenue growth, revenue growth, revenue growth. In fact, Wall Street again is expecting revenue growth for the quarter that is about to be reported. That tells me that's another positive sign, right? The analysts have said here, there are people who are on SMIs, they're saying as well that there's going to be revenue growth. Great. So what do? I execute. I don't play around, right? I saw the 70%. I know the economic factors, right? If the job report comes in 230 to 275, great. That means we're at a steady pace. If it comes in lower, even better, right? That means that the jobs are slowing down, which means capital will slow down, which means spending will slow down, which means the Fed might say, all right, maybe we'll cut rates. So I execute. And this is the reason I did this, right? Usually I do more calls, but I want to show people that you don't have to have $100,000. You don't have to have $25,000. I bought 4 calls, right? At $13.50. That really means, and if you're in the options world, that means that you're paying $1,350 per contract, right? So I bought 4 calls. This happened on May 2nd, this last week, Thursday. I execute. Let's see what happens. What's the result of that execution? All right. The news comes out Friday. Employers hired 175,000 workers in April. That's great news. Why? Well, had the number come in higher than March, which was the previous month, we would have had a sell-off, right? The confidence in rate cuts this year would have come into question, right? So if there was going to be no rate cuts, then we would have seen the market come down a bit, in my assumption. Now, I'm not an economist, but that is my educated assumption that would have happened if that number came in. Let's say 500,000 jobs were created, right? If there was more creation, more capital, more money in circulation, the Fed would have never looked at that and said, all right, well, we need to cut rates. That didn't happen. It actually came in lower than expectations. And so, thankfully, it didn't. And in return, we saw there was an uptick in the market on Friday. So when you're talking about economic factors playing a role in the market, this is exactly how it works. It played a role. We saw an uptick on Friday. We saw an uptick today. Now, when I bought that call, HubSpot was trading at $592. And so that's what the stock was trading at, $592. When the market opened today, it was at 610. By noon, it got down to 609. It's hovering around that 609, 610 number, right? But that's for the stock. And so we saw a movement of about $18, right? But on the option side, let's see what we're able to pull off. There we go. We watched in 2 days, right? And from a really detailed research look into a company, knowing its history, watching its chart. In 2 days, we were able to gain 74% on our investment. Now, is it easy? No. Is it calculated? 1,000%, right? With strategy, with discipline, with focus, this is obtainable. All right. So the key thing is to have your strategy, but more importantly, execute. Right. Didn't take me $100,000 to do it. Didn't take me $25,000 to do it. I bought 4 contracts at maybe $1,300. Right. But that money has now grown by 73%. And of course, since it's short term, I took my profit. Because I just wanted to show you that it is possible and it's doable. You have to execute. You must execute. Appreciate y'all. Well,
there you have it, ladies and gentlemen.
Gotta execute.
Hey, man.
Wonderful presentation.
Gotta execute, man.
It's all about information. And, the good thing with stock options is that you don't need a lot of money to make a lot of money, right? Because it's a risk reward ratio. So you have to be careful. You don't want to put money that you don't bet the house on next week's Tesla call. But if done right, if you have the proper education, I mean, you can make a pretty substantial amount of money in a short period of time. When you're talking about a 70% rate of return, 100% rate of return, 200% rate of return, what's the most that you've ever had as far as rate of return?
1,800%.
NVIDIA last year.
I had NVIDIA this year got up to 1,700. I think I had an SMH in 21. That was yeah, crazy.
So it's one of these things, right? So the options has become very popular over the last couple of years, but a lot of people lose money in options. Most people lose money in options, and I think a lot of it just goes down to emotion and education. Emotionally doing things that just aren't rational, and then not properly educated on how to actually strategically navigate the field. So it's not something that you can just play around with. Like if you're going to do options, you shouldn't put probably more than at least 10% of your portfolio into options. And then B, you should be well equipped, right? It's like going to war. Like you should be well equipped and educated on what you're actually doing. But the good thing about it, like I said, is that if you have a few home runs in this situation, you could, potentially change your life off of options quicker than if you just invested in long-term stocks. So not to say you should always invest in long-term stocks, but it gives you leverage to kind of accelerate, money with short money as opposed to, not having that option.